Hi, I'm Christian Chan, Chief Investment Officer at AssetMark. All eyes were on the Fed this quarter. The Fed's dual mandate is a tough one. It's tough because one mandate, full employment, is somewhat opposed to the other mandate, low inflation. This chart shows the core inflation rate and the unemployment rate from the start of 2000 to just before the pandemic. And you can see that when the unemployment rate is going down, the inflation rate tends to be going up. And when the unemployment rate is going up, the inflation rate tends to be going down. So when the Fed hiked interest rates to lower inflation, as it did in 2022, a lot of people were concerned that the unemployment rate would increase. Thankfully, during this rate hiking cycle we've been in over the last couple of years, inflation has fallen and the unemployment rate has stayed relatively low. At their September meeting, the Fed moved on to the next phase in the rate cycle, interest rate cuts. In my view, they opened the rate cutting cycle with a larger than typical half percentage point reduction for two reasons. First, the Fed believes the current level of interest rates is overly restrictive, meaning they think of this rate cut as removing restriction to economic growth and not so much stimulating growth. That's a subtle but important distinction that makes the 50 basis point move seem less extreme. Secondly, the labor market is slowing, but it's still pretty healthy. The chart on the left shows the unemployment rate over the last 50 years. You can see that unemployment in the most recent periods has ticked up, but relative to the last 50 years, unemployment is very low. On the right, we show job openings. Those have come down a lot since the peak levels during the pandemic, but you can see that we have more job openings today than we've had at any time over the last 25 years. So we're not sure if this slowing is normalization coming off of a very unusual pandemic period or weakness that may lead to a recession. So far, measures like advanced layoff notices and job cut announcements look okay, but we're keeping a very close eye on those types of measures. Historically, rate-cutting cycles have had three main characteristics. The first characteristic is a higher probability of recession. Historically, the Fed has cut interest rates after the economy has already weakened or is entering or has already entered a recession. The chart on the left shows the average growth and unemployment rate at the beginning of every rate-cutting cycle since 1970. The chart on the right shows the growth and unemployment rate today. You can see that compared to past cutting cycles, today's cutting cycle started with pretty strong growth. We had a 3% second quarter GDP print, and we're tracking towards something similar in the third quarter. And unemployment rate is at 4.2%, well below the historical average of almost 6% at the start of Fed cutting cycles. So the Fed is cutting rates early, suggesting that a soft landing may be possible. The second characteristic is higher equity market volatility because of the higher risk of recession. This tends to matter more over the short term, like the next 1 year, and less over the intermediate term, like the next 3 or 5 years. The third characteristic is above average returns for both stocks and bonds. Both asset classes tend to perform well during rate cutting cycles, particularly over the 3 to 5 year time horizons. So what should investors do? First, ensure that your cash allocation is in line with your long-term investment plan. The yield environment over the last couple of years has definitely favored cash over bonds, and as the Fed gets further in the cutting cycle, the yield advantage will likely shift towards bonds. So making sure you have the right cash allocation is really important. Second, revisit your asset allocation to ensure it's aligned with your long-term goals. While this economic environment is associated with a higher level of recession risk, it has also been associated with healthy returns for stocks and bonds over the 3 to 5 year time horizons. Third, get invested and stay invested. With an increased risk of recession and upcoming elections, market volatility is likely. Investors who can stay disciplined could be rewarded with above average investment returns. Take the opportunity to get cash off the sidelines and get invested. Thanks for watching. We'll talk to you next quarter.